Welcome, everyone, to our third quarter investments and markets review. My name is Travis Dugan, and I head up the portfolio management team here at SVB Asset Management. Joining me today are senior portfolio managers Jose Sevilla and John Schwartz. We're excited to provide you with an update on the markets and on our current investment strategy. First, let's go over some housekeeping items on the next slide. All lines have been placed on mute to prevent background noise. The Q&A function is enabled for attendees to submit questions to the presenters. We will address questions time permitting. And finally, we'll send a link to the presentation after the webinar. All right, let's jump right in. Jose, can you start us off on this slide with an overview of the current investment themes?
Well, thank you everyone for joining today. For today's webinar, as Travis had mentioned, I'm going to be focusing on, providing a quick brief market update and focusing on the current state of the economy, drilling in on the current state of the job market and inflation. Then I will hand it over to my colleague, John, to provide an update on the Fed, their rate outlook, and he will close the webinar on how to strategically position your portfolio in this current environment. So let's begin. So I'll start with some key macroeconomic trends that we've been seeing lately. The current economic conditions can be characterized as a highly uncertain environment in which markets could face a higher, more persistent inflation, more adverse labor market developments, possibly both. And so what do we do? What do we know? I mean, growth is slowing, job market is weakening, inflation remains elevated above the Fed's 2% target. And this could all complicate the Fed's dual mandate of achieving maximum employment and price stability. So focusing on the bottom chart there on growth, I mean, the US economy is showing signs of slowing down with forecasts indicating below trend growth. Third reading of GDP for the Q2 was revised higher to 3.8%, driven by strong consumer spending. Market acknowledged that the consumer has been resilient this year. However, compared to last year, overall consumer spending has slowed. I mean, consumer confidence has been mixed, and just as level set us to today, the economy has experienced a contraction in Q1, followed by a rebound in Q2. However, the overall trend still points to a deceleration. The outlook for growth is to slow and likely to be driven by slower consumer spending, which is driven by consumer pessimism about job security and concerns about higher inflation. Businesses will probably slow, if not halt, their spending plans due to uncertainty around trade policies and tariffs. One thing we have seen is the balance of risks have shifted as recent data indicate that the downside risks to employment have increased relative to the risk of inflation remaining persistently above target. So why don't we drill into the current state of the job market? The US labor market, as the slide has indicated here, has cooled since the beginning of the year. August payroll reports fell short of expectations, adding about 22,000 jobs, while estimates were calling for 75,000. The revisions from the previous 2 months also have shown a drop, indicating a much weaker pace of hiring than initially thought. As you can see on the chart on the right, wage growth has cooled from its peak. Meanwhile, the unemployment rate currently stands at 4.3%. That's the highest in 4 years. From the previous slide, I took the average of the last 4 months of job additions, and the US had added an average of only 27,000 jobs per month, while the first 4 months of the year, we added about 123,000. So a dramatic drop there.
Good points, Jose. Today, what we're dealing with, still on the labor part of our equation, that data is really important. We know that data helps the Fed to determine what to do with rates. But one new twist that we're facing today is the US government shutdown. We know the Fed needs to look at all of this data. How does a shutdown impact some of these economic reports like the non-farm payrolls? They're supposed to come out this Friday.
No, good question, Travis. I mean, it really depends on how long the shutdown lasts and what contingency plans are being put in place. The likely outcome for this Friday's payroll report release will likely be delayed, as everyone is anticipating. BLS, the Bureau of Labor and Statistics, plans have indicated that the data collection will cease or halt. And the risk here is if the survey data collection is halted, this may compromise the quality of the data even after the shutdown ends. So this puts the Fed in a really tough spot because that is less visibility on the current state of the job markets, which could put or increase uncertainty, I should say, in the in monetary policy decisions.
Yeah, those are great points, and obviously that information is super important for forming Fed decisions. Now, I really like what you've talked about in the labor market, and we are seeing that cooling. Let's talk about the inflation side of the equation. What's going on with inflation? What's of concern that you see, and what the Fed is thinking about there?
Sure. I mean, turning to inflation and the current annual inflation rate, as you all know, from the August CPI report, annual inflation rate currently is 2.9%. That's basically unchanged from the previous month. Meanwhile, core CPI is currently at 3.1%. While inflation has come down significantly from the highs of 2022, it has remained stubbornly above the Fed's 2% target, as I stated earlier, suggesting that price pressures are proving more persistent than expected. The primary driver, at least recently, of persistently high inflation is higher shelter costs, along with rising energy and food prices, and also used car prices. In fact, just to kind of drill into that point, shelter costs, basically rents, is 36% of CPI index, and that increased about 0.4% in August. Meanwhile, energy prices rose by 0.7% over the month, with gasoline up about almost 2%. And used car prices and trucks also have seen a significant increase in prices. So we have also, on the other hand, too, is we have not seen the full effect yet, but tariffs can also be a culprit, disrupting supply chains and continuing to put upward pressure on prices.
Great insight, Jose. That's really helpful. Let's move on now to the Federal Reserve and talk about our current strategy. Hey, John, we know that the FOMC met on September 17th. What did you make of that meeting, and what actions do you think the Fed is going to take over the next couple of meetings?
Yeah, thanks, Travis. I'd say my main takeaways from the FOMC meeting we got a few Wednesdays ago was encapsulated in the summary of economic projections that the Fed shared, which is their forecast for the economy over the next few years. Forecast for unemployment, inflation, GDP, as well as the Fed funds rate. So they share this forecast once a quarter, so every other Fed meeting. It was interesting to see that they did not update their view that unemployment would get to 4.5% by the end of the year, and core PCE would get to 3.1% at the end of the year. So you've got slightly elevated inflation from where we are right now, and firmer inflation, or elevated unemployment and firmer inflation as well. But the forecast didn't change from the one we got at the prior forecast in March, or as of in June. So it's interesting to see the Fed's view on the path for Fed funds change for the end of 2025. The prior forecast had us getting 2 rate cuts this year, and inclusive of the rate cut that we got in September, the Fed's forecast now includes 3 rate cuts for 2025. So you have kind of a similar economy, but we have a more accommodative Fed. And I think that kind of speaks to Jose's point around the balance of risks that have shifted. So we can move to the next slide. So the Fed is more concerned around protecting against employment than they are against rising prices due to inflation. So this slide here shows you, it compares 2 expectations. You've got the market expectations about what the Fed is going to do, and you have the Fed's forecast. So if you're looking at the December 10 column of data. The dark bars on this chart are the Fed's expectation. So the Fed says we have 2 more cuts this year. These are the Fed meetings across the bottom. So at each of the next 2 Fed meetings, the Fed's saying we're going to cut at each of those meetings, 125 basis point cut at each meeting. And the market view is the turquoise bars, which are showing the market expectation of 1.6 cuts for this year. So the market and the Fed are largely in agreement for the path for Fed funds for the rest of 25. And then looking into the future, you can see the market expectations are 3 cumulative cuts between now and June. The Fed is a little bit less than that. They only have 1 full cut penciled in for 2026. And so if the market view, if we get 2 and 25, we're going to get somewhere between 3 and 4, potentially. That's just by June of next year.
All right, John, that's great. So the Fed's cutting, the Fed cut, and they're going to keep cutting. The pace is, there's somewhat agreement, but it sounds like there over time could be a little bit of changes between what the Fed's forecasting and what the market is forecasting. Can you now give us an update on the markets and our current investment strategy?
Sure, perfect. Yeah, so when I look at this chart, this is showing you the path of 1 and 2 year treasuries over the last few years. So looking at what rates have done this year, especially if you're thinking about 1 and 2 year treasuries, they're going to be especially susceptible to Fed funds expectations. So the rates clearly have been on a downtrend since the beginning of the year. The market probably expecting some amount of rate cuts earlier in the year that never materialized, but now essentially the market has pretty clear line of sight to a good handful of rate cuts. And the Fed, unlikely that they would have cut in September if they weren't planning on delivering a series of cuts. Obviously, the data can change. If we get firmer inflation, the Fed may need to think about cutting less, or if we get a further breakdown in the economy, you could certainly see expectations for more rate cuts and accelerating the timing. But this is showing you the path of interest rates and kind of seeing the downtrend and the sensitivity to Fed expectations. We can move to the next slide. So it's important to understand if you have cash in a money market fund, you're even more exposed to Fed expectations or the actions delivered by the Fed. This is showing you 25 years of history of money market fund yields compared to the Fed funds rate. So if the Fed is moving the Fed funds rate either up or down, that money market fund is going to react very quickly. And it doesn't move with market expectations, but it moves with Fed action. If the Fed is taking action by cutting those 3 rate cuts between now and June, the money market fund is going to react almost hand in hand. So the correlation between these 2 lines is especially high.
Yeah, that makes a lot of sense, John. So you're telling us the money market fund rate looks good today, but because the Fed's expected to cut, that rate's not going to look so good down the road going into next year. When you think about investment strategies, how do you think about those strategies in a declining rate environment? And why should clients really, how do they benefit from locking in these yields?
Yeah, so if we move over to the next slide, I think this basically summarizes the essence of what we do here in SVB Asset Management. If you're looking at the 12-month part of this chart, this is showing you a few different things. The turquoise bar is showing you what's expected from the Fed over the next year. So you have about 93 basis points of cuts. Let's just call it 100 basis points of cuts over the next year. So it's important to think about where is the money market fund going to yield over that time period. So we're currently at 4%. If the Fed cuts 100 basis points, we get down to 3%. So it's important to understand what's the average over that time period. Yeah, 3% is the destination, but we started at 4%. So the midpoint or the average of these 2 yields is around 3.5%. So that's what you can expect the money market fund to return if the Fed delivers the 4 cuts that the market's expecting over the next year. Well, what can you do to protect against that money market fund yield dropping? Well, you can buy a U.S. Treasury. A 1-year Treasury is yielding 3.72. So clearly, if the Fed is delivering on the market expectations or more, Fed could easily deliver more cuts than the market's expecting. We're going to have a change in the makeup of the Fed next year. Powell's job will be over in May. if not sooner, there's going to be a very friendly Fed to cutting interest rates. Perfectly reasonable to expect more rate cuts than the market is currently expecting. If the Fed delivers those cuts, treasuries are going to likely beat money market fund yields. And then for our more sophisticated clients, we have a comprehensive investment strategy where you can invest in corporate bonds and asset-backed securities that will further insulate investment portfolios from the Fed cutting interest rates in the future.
This is a great chart, John. I think this is a pretty new one that you helped put together, and I think it really shows at a very high level, kind of a menu of yields you can get from different investment strategies. And also it shows that by investing, you are locking in yields and reducing the uncertainty of forecasting your cash versus a money fund where you have that uncertainty of the pace of Fed cuts. So this is really great. Let's move on to the next slide. Just want everybody to know that we have additional materials on our website on svb.com. We publish a lot of materials, both on strategy, both on research, and feel free to reach out there and look for more reference materials. On our next slide, I just want to, before we wrap up, we wanted to try to address some questions. I know we have some time. And one of the questions that's come in, and tariffs. I know, Jose, you spoke to tariffs a little bit earlier. It's a hot topic for everybody. It's a topic that's still a lot of uncertainty, and just wanted to come back to that a little bit and kind of pick your brain, and then maybe John afterward, about the tariffs. Like, do you think that tariffs are going to not only push inflation higher? I know you talked to that a little bit, but do you think it'll be a persistent push higher? And is it something that the Fed needs to worry about?
No, Travis, great point. Yes, I mean, the immediate answer is yes. I mean, everyone is concerned. Markets, economists, policymakers are all concerned that tariffs could push inflation higher or will push inflation higher. While some of those effects may be gradual, maybe even debated, the consensus is that they will create upward pressure on prices for both consumers and businesses ultimately. There's been talks of businesses eating some of these price increases, limiting that pass-through effect to consumers, but how long will that last and how much can they absorb before really putting a dent into their margins really remains to be seen. Some economists have even argued that tariffs represent possibly a one-time upward shift in price levels. Others have warned that they could lead to a more lasting inflationary cycle. And to kind of touch on that pass-through effect, that is also mixed. I mean, recent reports indicate that middle to lower income earners are disproportionately affected by the rising costs of, say, groceries and other essentials. And some have said that it could be, that a two-tiered economy is emerging here where higher income households can absorb these price hikes while others cannot. I don't know, John, is anything to add there?
Yeah, I think the impact of tariffs on inflation is expected to be real, and you'll see it come in various different forms. And even the Fed speaks to this. They expect firmer inflation. So it's interesting to see them think about cutting rates and delivering rate cuts with firmer inflation. But they speak to it in the idea that they're willing to look through it. It hopefully should be theoretically just a one-time impact on prices. Tariffs theoretically should not just continue to climb. So as long as you believe that's the case, the push up in prices should be a one-time thing. Current businesses are working through inventory that they have that haven't been tariffed yet. So the feeling or the impact is going to be felt probably sometime by the end of the year or into next year. But the Fed's willing to look through it and focus their attention on the deteriorating employment outlook as opposed to what should be a one-time push up in prices.
Well, great, guys. Really appreciate the insight on that. And we'll continue to watch that as we do from every day on the trading floor and as we're thinking about strategy for our clients. I don't see any more questions in the queue, so we may end a little bit early here. I just want to thank everybody for joining today. We really appreciate you taking the time out of your busy schedules. feel free to reach out to anyone on the portfolio management team or other the liquidity account management team. If you have any follow-on questions, we would be happy to continue to dive deeper on these subjects. Thanks a lot and have a great day.